Right. Thank you very much, Megan. Well, you might have heard the president proposing a 50-year mortgage for prospective home buyers to help them get into a home for a lower monthly payment. But what are the pros and cons of such a long-term loan and others? Joining us now to explain is Brian Goldman from Guild Mortgage in Mountain Brook. Brian, good to have you with us this morning.
Hey, thank you for having me, Mike.
All right, let's dive right into this. Obviously, the terms of a loan dependent on a buyer's situation. Yeah. But what would be some of the pros and cons of a 50-year mortgage?
Yes. So the biggest thing right now is it's not passed. It's not a real loan yet. It's just in discussion. So anything that anybody says is just pure speculation. Okay. But what we can do is we can take a lot of the data that we have from looking at other loans that are in play right now. Okay. So take a 15-year versus a 30-year right now. Mm-hmm. The rate on a 30-year loan is going to be about 0.6% higher on an interest rate than a 15-year. So if you take from a 30 to a 50, mm-hmm. we have to assume that that rate's also going to be a little bit higher than what it is on a 30. So,
and if the interest rate's higher over the term of that loan, you're going to be spending a lot more on that home. But I would think most people who get a 50-year are not going to stay in that home for 50 years.
That's right. So most people move on average of about every 12 years or so. Mm-hmm. The other interesting fact, though, is most people only keep their mortgage for less than 10 years. So whether it's them refinancing, moving up to a bigger house, divorces, any of those situations would impact someone having to refinance or do a different type of loan. So even though somebody may get a 50-year loan, the chances of them keeping that are very slim. Only 2% of 30-year mortgages make it the full 30-year term.
So now if somebody's getting a 50-year, though, the advantage of that is, you think it would get more people into buying homes and also, trying to get a 50-year mortgage?
Yes. I don't think it's going to be as many people as what people are making it out to be. I think a 30-year mortgage is still going to be the dominant mortgage that most people go with. The 50-year is going to be a very specific borrower who needs that. And when you look at the payment savings on a 50-year versus a 30, it's not as, so if you look at a 15 to a 30, it's a big jump. Right. Okay? It's a big payment difference. Mm-hmm. But a 30 to a 50, it's not near as big of a payment jump. So it does save you money on a monthly payment standpoint, but not as much as most people think. I will tell you one cool thing about a 50-year where I could see some people using it. The amortization schedule. So just because it's called a 50-year loan doesn't mean you have to do the loan for 50 years. You could choose to do a 32-year mortgage or a 35-year mortgage or a 40-year mortgage. It doesn't have to be a 50. So if you have someone whose debt to income is really tight and they're on the verge of qualifying or not qualifying, maybe we could take them from a 30 to a 35-year or 33-year, and now their debt to income gets back in line, and we're able to get that borrower in a house.
So basically, this opens that window for those who are in that situation.
That's correct.
Okay. All right. Real quick as we wrap up now, we know adjustable rate mortgages played a factor in the housing boom that happened in the late 2000s. What about the rules and regulations on that now? We've had different administrations come into the White House. Is it the same now? Are those protections in there still so people don't end up upside down?
Yeah, absolutely. There's still protections, and I don't know what percent of the market ARMs actually are, but they're a very, very low percent. If we do 100 loans in a month, one of those may be an ARM. Usually it's not even that many.
All right, that is Brian Goldman. He's a mortgage expert with Guild Mortgage in Mountain Brook. Brian, thank you so much. Appreciate it.
Thank you, Mike.
All right, we'll be right back.